So far, we've learned about investing offshore in countries in Europe, Switzerland. Eric came up and talked a little bit about Austria and Denmark. We want to continue the conversation about investing and banking offshore, but we want to change locales. We want to go somewhere a little closer to home for those of us that are American citizens, and we're going to head down to the Cayman Islands. So our next speaker is the CEO of Caledonian Global Financial Services, which is located in the Cayman Islands, and he's going to talk to us about just that, the myths and realities of banking in the Caymans. Would you please welcome to the stage Kobi Dorenbush.
Thank you. Good afternoon. My name is Kobi Dorenbush, and I'm the CEO of Caledonian Global Financial Services. We're a privately owned financial services provider based in the Cayman Islands. We provide all forms of financial services, including banking, brokerage, custody, wealth management, and fiduciary services, including incorporations and trust services. We've been in operation for almost 45 years, and we're the oldest private bank in the Cayman Islands. Currently, we have about 120 employees in 4 jurisdictions, and we're working with about $30 billion in assets. I'm a Canadian lawyer by trade, but I live and I work full-time in the Cayman Islands. When people find out that I live and work in the Cayman Islands, I'm often asked a very particular question that I just like to answer for everybody right now so that we don't have to do it later. I can neither confirm nor deny whether or not we work for Mitt Romney. But really, when I tell people that I live and work in the Cayman Islands, and particularly when I tell them that I'm the CEO of a bank in the Cayman Islands, I'm often met with questions and comments about hiding money and curious looks that imply that I'm doing something wrong. I am always asked about that certain movie, that John Grisham movie with Tom Cruise. Everybody know what movie that is? The Firm. You know, The Firm branded itself onto the Cayman Islands. It put Cayman onto the map, but it did so in a really negative way. It was a very successful mainstream movie about the mafia and crime and money laundering and scuba diving, and it really left an impression of the Cayman Islands on the world. So in fact, when you live in the Cayman Islands and you meet somebody that gives you that curious stare that implies that you're doing something wrong, we call that the Grisham effect. Personally, I have a very unique perspective on this subject because of this man, William S. Walker. Bill Walker is widely regarded in the Cayman Islands as the founder of the legal infrastructure that built Cayman into the financial center, or tax haven, as some people call it, that it is today. And for his work, Bill Walker received an Order of the British Empire from the Queen of England. Now, for those of you who don't know, the OBE distinction is one step away from a knighthood. Now, in addition to being effectively the founding father of the Cayman Islands legal and business infrastructure, Bill Walker is also my predecessor. Bill Walker is the founder of my firm, Caledonian Global Financial Services, and he is the former CEO. So I have some pretty big shoes to fill. Critics of the Cayman Islands and other offshore jurisdictions say that favorable tax rates encourage corporations to avoid paying American taxes by structuring complicated international transactions. But it's not just the low tax rates that make these jurisdictions attractive to those following the rules. The secrecy of offshore jurisdictions allows some individuals and corporations to engage in outright tax fraud, costing America at least $40 billion each year. That's a quote from a piece written by Robert Morgenthau, former district attorney in the borough of Manhattan. But is this really the case? Is the Cayman Islands encouraging otherwise law-abiding U.S. citizens and corporations to violate the laws of the United States? Is Cayman keeping secrets? I don't think that it is. Critics of the Cayman Islands and those within the mainstream media promote a very stylized impression of the Cayman Islands so that they can push their own particular agenda or so that they can sell tickets to a movie or novels. But today what I want to talk to you all about is the truth about doing business in the Cayman Islands. And the truth is that Cayman plays by the rules. Cayman is a party to numerous international information sharing agreements. And even the US government, when it writes about the Cayman Islands in its official reports, admits to this. The truth is that the Cayman Islands provides a very valuable service to the international business community. And the truth is that doing business in the Cayman Islands is not much different than doing business in New York, or in Toronto, or in London, except our weather is a lot better. So, firstly, although I live and work in the Cayman Islands, I do not work on the beach, and I do not wear flip-flops to work. My assistant thought that this would be funny, to put a picture of me in there. The Cayman Islands are located just south of Cuba, a 1-hour flight away from Miami. The population of the Cayman Islands is about 55,000 people, of which about half are expatriate workers from around the world. The Cayman Islands is the 5th largest banking center in the world. There are approximately 250 banks in the Cayman Islands. Today, there is approximately $2 trillion on deposit in the Cayman Islands, which equates to about $36 million on deposit for every man, woman, and child in the Cayman Islands. Approximately 1% of the Cayman Islands population are lawyers. Now, normally that would actually be a very frightening statistic, but when your economy is based on providing international financial services, it's actually quite helpful. The Cayman Islands has a GDP per capita of about $43,800 a year, which ranks it as the 18th highest in the world. Now, just to give you some perspective on the GDP rankings, the next country, the 19th one, is Canada. Number 20 is Australia. Sorry, just having a little trouble. There we go. When you hear a reference to the Cayman Islands, there are probably a handful of images that come to mind. A nice beach, palm trees, Tom Cruise, and of course the words tax haven. But what do people mean when they refer to a place as a tax haven? There usually are a few characteristics that you can count on. Number one, the ability to establish a shell company. Number two, confidentiality or secrecy with respect to your financial transactions. And number three, of course, very little or no taxation. Now let's talk a little bit about shell companies first. A shell company is a lot like a holding company. It has no physical operations, it has no employees, and has no active business. The purpose of a shell company or holding company is simply to hold assets like real estate or cash in a bank account. Now, the use of holding companies is very common throughout the business world. However, there is a critical difference between a holding company and a shell company. With respect to a holding company, typically the ultimate beneficial owner of that holding company and the assets of the holding company are typically fully disclosed to the relevant authorities. But when you're dealing with a shell company, the very purpose of a shell company is to obscure its assets and to obscure the identity of the ultimate beneficial owner so that the governments can avoid or not able to regulate them. Over the past decade, financial services providers have implemented important due diligence requirements so that they would know the identities of their customers. To make sure that the financial services providers will not unwittingly be part of some sort of a financial crime. But criminals have responded by interposing these shell companies to disguise their activities and to disguise their identities. In 2012, researchers from 3 U.S. universities conducted the largest and most in-depth study of the use of shell companies in the world to date. Now, posing as consultants, the authors asked 3,700 incorporation agents in 182 countries to form companies for them. Now, the authors sent 3 main types of emails. The first from a low-risk alias from a country such as Norway or Australia. The second from a high corruption risk individual purporting to work in government procurement in places like Kyrgyzstan or Equatorial Guinea. And third, a terror financing risk working for a Muslim charity based in Saudi Arabia. Of the incorporation agents who responded to these inquiries, 48% failed to ask for proper identification. And of the ones who did, half of them did not ask for any documentation at all. Contrary to conventional wisdom, providers in tax havens, or the so-called tax havens such as the Cayman Islands, were actually much more likely to comply with the standards set out by the FATF than service providers in the OECD. Researchers found that only 10 of the 1,722 incorporation agents in the United States required notarized documents in line with FATF standards. Now, as you might expect, finding service providers to respond to the email inquiries from these authors became increasingly difficult as the types of emails escalated. But what they did find was that once they did get a positive response, these service providers were also less likely to ask for any documentation. Finding corporate service providers that were willing to respond positively to the terrorist financier was obviously the most challenging, but it was not impossible. 1 in every 17 incorporation agents asked was willing to set up an anonymous shell company for the supposed terrorist financier. When the undercover authors offered to pay a premium to ignore these rules, the demand for identity documents fell dramatically. One corporate service provider from here in the United States said, "Your stated purpose could well be a front for funding terrorism, and who the F would get involved in that? Seriously, if you wanted a functioning and useful Florida corporation, you'd need someone here to put their name on it and set up bank accounts, etc. I wouldn't even consider doing that for less than $5,000 a month. And I doubt you are going to find any suckers that will do it at all, do it for less, if at all. If you're working with less than serious money, don't waste anybody's time here. Using an effing Google account also shows that you are just an effing poser and a loser. If you have a serious proposal, write it up and we'll consider it. Your previous message and this one are meaningless crap. Get a clue. Just how stupid do you think we are?" I wonder what this guy would do for $10,000 a month. This study, by far the most in-depth of its kind, showed that service providers in the wealthier OECD countries, including the United States, Canada, and Britain, showed little regard for the international rules on facilitating financial crimes. This chart breaks down by jurisdiction the average number of attempts that the authors were required to find a corporate service provider who is willing to set up an untraceable shell company. Now, you'll note that US law firms are actually very resistant to the authors' approaches, but US incorporation services were actually the least resistant, followed closely by Canadian service providers. The OECD average was not far behind them. But the so-called tax havens, like the Cayman Islands, were actually more than 5 times more resistant to the author's criminal solicitations than US incorporation agents, and actually more than twice as resistant to the OECD average. As The Economist wrote in an article on September 2nd, 2013, movers of dirty money know where the best shells are to be had, and it is not on a Caribbean island. Let's look specifically at the Cayman Islands. Cayman is home to approximately 95,000 companies. Now, when critics of the Cayman Islands hear that number, and then they compare it to the only 55,000 residents of the island, they immediately suspect that these companies have some illegitimate purpose, that they're part of some big tax sham. But the truth is that international businesses come to the Cayman Islands for a few important reasons. First, Cayman has a sophisticated body of corporate and commercial law based on the English common law system. Second, we are regulatory neutral. The Cayman Islands does not impose any significant regulatory obligations on exempt companies that choose to operate in the Cayman Islands and go forth to the rest of the world and do their business. And third, tax neutrality. The Cayman Islands does not impose any personal income tax, no corporate income tax, no capital gains tax, no property tax, and no inheritance tax. This is a photo of what has become one of the most infamous buildings in the Cayman Islands, and it was made infamous by President Obama during his first presidential campaign, when he referred to this building as either the biggest building in the world or the biggest tax scam in the world. Now, the building that President Obama was referring to is called Ugland House, and it's the head office of the international law firm Maples and Calder. It's located just outside of Georgetown and overlooks the Caribbean Sea, and it is the registered address of approximately 19,000 Cayman Islands companies. But what about this place? This is 1209 North Orange Street in Wilmington, Delaware. And it's the home of the Corporation Trust Center, from where they provide similar registered office services to the services provided by Maples and Calder from Ugland House. But the big difference is that at 1209 North Orange Street, it's the registered office of approximately 285,000 companies, LLCs, and partnerships registered in the state of Delaware. And it's funny because this building actually looks a lot smaller than Ugland House, but by President Obama's math, it should be over 10 times the size. Notable companies that have this office as their registered address include Google, American Airlines, Apple, General Motors, Coca-Cola, Kentucky Fried Chicken, Verizon. Deutsche Bank alone has over 2,500 companies that call this address their home. So if Ugland House in the Cayman Islands, with its 19,000 companies, is the biggest tax scam in the world, as President Obama likes to say, then what does that make 1209 North Orange Street? If the Cayman Islands is a tax haven because it's home to only 55,000 people but 95,000 companies, then what does that make the state of Delaware? The state of Delaware has 870,000 residents, which is about 0.3% of the US population. But more than half of the country's publicly traded companies are registered in the state of Delaware, including 60% of the Fortune 500 firms. But it's not likely that President Obama would criticize Delaware the way that he's criticized the Cayman Islands. Vice President Joe Biden was a former senator from the state of Delaware. And there's an important economic factor to Delaware's incorporation industry as well. Last year, Delaware took in $775 million in annual fees from its incorporation industry, from all of the registered agent fees that are due. That accounted for nearly 1/4 of the state's entire budget. The Prime Minister of Luxembourg recently said that if his country was to be picked on as a tax haven, then Delaware should get the same treatment. And that's not the only example of the double standard. We can all recall the criticisms that the Obama administration threw at Mitt Romney during his presidential campaign for Mr. Romney's investments in Cayman Islands-based hedge funds. Now, even though Mr. Romney claims that he disclosed all of his assets in the Cayman Islands and paid the full amount of taxes that were due on them, the Obama campaign was successful in presenting a very negative image of Mitt Romney because of his mere association to investments in the Cayman Islands. However, just this past year, President Obama nominated Jack Lew to the Treasury Secretary, despite objections that Mr. Lew invested heavily himself in funds based at Ugland House in the Cayman Islands. Now, in that case, President Obama very conveniently said that he was not concerned about Mr. Lew's past financial transactions. A lot of people refer to the use of holding companies and trust structures as a way to provide secrecy. Now, in fact, critics of the Cayman Islands and other offshore jurisdictions say that secrecy is a tool for evading taxes or claims. But there's a very important difference between secrecy and confidentiality. Keeping a secret is to have an awareness of information that you ought to disclose, but you fail or refuse to disclose. Keeping information confidential, on the other hand, is the practice of not disclosing information that you ought not to disclose. Now, as a regulated financial services provider in the Cayman Islands, we are obligated by local law to collect information to establish the identity of all of our counterparties and our clients. When it comes to our clients in particular, we are also required to have an understanding of their businesses, their sources of income, and to understand the use of any cash that flows through our control. Now, none of this information is kept secret, but it is kept confidential. There are some instances in which confidential information is required to be disclosed by us, but there is also information where we are obligated not to disclose it. Now, after 2008, the OECD and the G20 announced a very aggressive approach to combating tax evasion. The OECD published a report that divided 82 nations into 3 categories. First, the whitelist. The whitelist listed jurisdictions that had substantially implemented internationally agreed upon tax standards. The second was a gray list, countries that had committed to these tax standards but had not yet implemented them. And finally, the blacklist, jurisdictions that had not committed to these standards at all. In order to be on the whitelist, a country had to sign a minimum of 12 bilateral agreements with foreign governments to agree to exchange tax information. The tax information exchange agreements also require that the exchange of information would obligate these governments to exchange what is otherwise confidential information despite local laws protecting it. The Cayman Islands has been on the OECD whitelist since August of 2009. Today, the Cayman Islands is a party to over 30 tax information exchange agreements. So despite the claims that the Cayman Islands are hiding information, these tax information exchange agreements indicate the exact opposite, that Cayman is actually committed to internationally accepted standards of transparency and cooperation. Some of the counterparties to Cayman's TIEAs include Canada, France, Germany, and the United Kingdom. And in the case of the United States, Cayman and the United States have held a mutual legal assistance treaty since 1986, which has subsequently been upgraded to a tax information exchange agreement as well. Now, some critics of the Cayman Islands point to a few local laws as evidence of Cayman's wrongdoing. For example, the Cayman Islands permits the use of something called a star trust. Now, a star trust is a trust like any other, with one very important distinction. At the time that the trust is formed, the settlor is not obligated to choose a beneficiary. Instead, what they can do is they can select a third-party individual who will then, at some point in the future, choose who the beneficiary will be. So for a period of time, the trust will have no beneficiary. Now, there are many good and proper reasons to have a star trust. For example, I have a client who is a resident of a country in the Middle East. He is the head of a high net worth family, and he is the father of several daughters. Now, he would like to include his daughters in his will so that they would share in his estate upon his death. But the custom in his country is that only his sons, only his male heirs, can participate in his estate. So we've set up a star trust for this client so that we can keep the identity of his ultimate beneficiaries of his trust confidential until such later times it is appropriate to designate them, when we will designate his daughters. So when you think of some of the services that we provide from the Cayman Islands, you have to consider that many of our clients do not share the same societal values that we do here in North America. Then there's the Confidential Relationships Preservation Law of the Cayman Islands. Now, this legislation says that if a person in the Cayman Islands violates their obligation of confidentiality, they may be subject to a penalty of up to 2 years in prison. Now, critics of the Cayman Islands see that and they think, aha, I got them. Cayman is up to something. They're hiding things. But let me give you an example of the value of this type of law. I have another client who is an international celebrity. Now, I obviously cannot tell you the name of this client because if I did, I might go to jail for 2 years. But I can say that if you've been to a movie in the past 10 years, you probably know who my client is. Now, unfortunately for my client, she happens to be going through a nasty breakup from her long-term boyfriend, and they're in the process of splitting up all of their financial assets. My client is concerned that if she splits up her assets from her U.S. bank, the employees at that U.S. bank would see this information, and they might sell it to the tabloid press. So what my client has done instead is they've moved all of their liquid assets to us in the Cayman Islands, and then we are making dispositions of those assets as they request. My client is comfortable that my employees at our bank will not disclose this information to the press because of the threat of literally 2 years in jail if they were to do so. So you have to also consider that many of our clients are not ordinary people. Many of our clients are celebrities or otherwise noteworthy people whose personal and confidential information is valuable for its sheer gossip value. Now, it's also important to note that an obligation to disclose information on a client as a result of a tax information exchange agreement would override Cayman's confidentiality law. Now, of course, critics of the Cayman Islands argue that the exchange of the tax information is actually of limited value because it requires a foreign government to request specific information on a specific person. There is no mechanism in the tax information exchange agreements for a foreign government to request general information on their citizens generally. Now, there is also good reason for something like this. I'll give you another example. I have a client who is a high net worth individual and a resident of South America. Now, a couple of years ago, his security team uncovered a plot to try to kidnap my client's children and hold them for ransom. My client learned that the kidnappers learned of his wealth from his annual tax filings that he provided to his government. Apparently, the kidnappers bought the information from somebody, an individual who worked in the government tax office. So you have to remember that most of our clients are not from the United States. Not all of our clients live in countries where their personal safety can be reasonably assured by their own governments. 85% of the world's economy exists outside of the United States, and many of our services cater towards non-US clients. So when you consider the services that Cayman provides, you have to consider that some of our clients may come from countries where making a disclosure to their own government might literally endanger their lives. Now, every Fortune 500 company makes use of offshore structures. In particular, there's a prevalence for technology companies to use offshore structures because the products and services that they sell are virtual. They're not tied to the land the way a manufacturing company might be. So the works of companies like Google, Yahoo, Cisco, and Apple can be done from anywhere in the world. And over the past 2 years, the 71 technology companies that comprise the S&P's 500 stock index, including Apple, Google, Yahoo, and Dell, reported paying worldwide cash taxes at a rate that on average was 1/3 less than the rest of the S&P 500. Recently, Apple has been in the news because of the sheer amount of money that they're holding offshore, over $100 billion. Now, 70% of Apple's global revenue comes from outside of the United States. And so what they've done is they have lawfully directed 70% of their revenues to holding structures in countries like Luxembourg, Ireland, and the Cayman Islands. By utilizing offshore structures, Apple was able to legally defer an additional $2.4 billion in US federal taxes this year alone. But as Apple's CEO, Tim Cook, recently said in his testimony in front of a US Senate hearing, Apple has done nothing wrong. Apple's income from its foreign subsidiaries is taxed at the rate of the country in which the income is earned. But under US law, that income is simply not taxed until it is repatriated to the United States. The important issue is that currently under US law, there is no obligation for Apple or companies like it to repatriate that income. So as Tim Cook said at his Senate hearing, if the US changes its laws, Apple will of course comply. But until that time, Apple simply will not do so. So I have to ask, what has Apple done that's so wrong? It is the obligation of every business operator, and in this case that's Tim Cook, to maximize the profits of his company in accordance with the laws that are applicable to him. Isn't that exactly what Tim Cook and Apple have done? They've generated a profit, and where not required to pay a tax, they've simply not paid it. Imagine if this was not Apple. Imagine if this was a small company that you made a private investment into. And then imagine that you get a call one day from the person that you've hired to run that business for you, and they say, guess what? I've decided to pay a tax that I don't really have to pay, and as a result, your dividend this year will be 1/3 less. What would you do? Wouldn't you fire that person? So to illustrate this point, let's imagine that we started our own company. Let's say that it makes widgets. Let's call it Widget Co. And like Apple, it's headquartered in the United States, probably in Delaware at 1209 North Orange Street. And then let's imagine that Widget Co. sells its widgets in the United States and in Germany and in Ireland. Let's then assume that it also makes $10 million per year in taxable profits in each of these three countries through active business income, for a grand total of $30 million in taxable profits. Widget Co. would pay $1.5 million in taxes in Germany, $1.25 million in taxes in Ireland. And then let's assume that Widget Co. decided to repatriate that income to the United States. And what would end up happening is it would pay 35% tax in the United States on its worldwide income, but then it would get a deduction for foreign taxes paid, so that the total of US taxes paid would be $7.75 million to the federal government in the United States, and a worldwide tax obligation of $10.5 million. But now let's assume that we interpose a Cayman Islands corporation. Let's assume that Widget Co. is still headquartered in the United States, like Apple. Let's then assume that it has a subsidiary in the Cayman Islands called Widget Co. Cayman, and let's then assume that Widget Co. Cayman owns its subsidiaries in Germany and Ireland. Let's again assume that Widget Co. earns the same amount of revenue it does in Germany and the United States and in Ireland through active business, and pays the same amount of taxes in Germany and Ireland. But this time, let's assume that Widget Co. does not repatriate its income to the United States. Let's assume that it leaves its money in the Cayman Islands. What would end up happening in that situation is that Widget Co. will pay only $3.5 million in taxes in the United States. When you add that to the taxes already paid in Germany and Ireland, you'd have a total worldwide tax obligation of $6.25 million. That's a savings of $4.25 million on a profit base of $30 million. That's about 40%. And that's just a very simple example. Imagine if Widget Co. had operations all over the world. Imagine if Widget Co., if their profits were in the hundreds of millions of dollars. The difference is simply too big to be ignored. Now, many people then turn to the morality of the issue. They try to say that Apple and companies like it need to pay their fair share to support the local economies in which they were founded. Now, I'm not going to go into the details of the charitable donations that Apple and companies like it make. That's very well documented. But there is another important aspect of this debate that people overlook. Data released in December of 2011 by Senator Carl Levin, he's the chairman of the same subcommittee that questioned Tim Cook earlier this year, That data shows that large multinational U.S. corporations with substantial offshore funds have already placed nearly half of those funds in U.S. assets and U.S. bank accounts. In 2011, the survey was sent to 27 U.S. multinational corporations to find that they held $538 billion in tax-deferred foreign earnings at the end of 2010. The survey found that 46% of those of that money, about $250 billion, was maintained in U.S. bank accounts or invested in U.S. assets such as U.S. Treasuries, stocks, and mutual funds. The survey also found that 9 of the 27 companies, including Apple, Cisco, Google, and Microsoft, held between 75% and 100% of their foreign tax-deferred earnings in the United States. So this notion that these offshore corporate profits are trapped outside of the United States, this notion that the U.S. does not benefit from these offshore corporate profits, it's just not accurate. Much of these profits do actually flow to the United States by way of a direct investment into the U.S. economy. By buying T-bills, these offshore corporate profits are investing in the U.S. government. Not a great investment these days, but by putting money on deposit in U.S. banks and by investing in other U.S. companies, they're making a direct investment in the U.S. private sector. Now, some critics of Apple and other companies like it take issue with the idea that Apple is jurisdiction shopping, that they're looking around the world to find a home that is where the criteria is based predominantly on tax benefits rather than traditional business reasons. But isn't a low tax rate a legitimate reason for wanting to move to a particular location? And if so, then isn't a high tax rate a legitimate reason for wanting to move away from a particular jurisdiction? Critics look at Apple and other companies like it and they say that it's unfair or that it's unpatriotic. But the fact is that individual Americans have been jurisdiction shopping for decades. Just this past year, after California implemented a new 13.3% income tax on high-income earners, pro golfer Phil Mickelson said that he was planning to move to Florida, where there is no state tax. Tiger Woods has even acknowledged that he left California for Florida in 1996 when he turned pro because of the difference in state taxes. In 2012, Tiger Woods earned $56.4 million. And had he stayed in the state of California, he would have had to pay an additional $7.5 million in state taxes that year alone. And it's not just celebrities that consider the tax advantages of living and working in different jurisdictions. It's been documented for many years that high-paid employees working in the financial sector in Manhattan choose to live across the river in New Jersey, where the state taxes are lower. So whether we like it or not, the fact is that taxation causes migration. And the choice to jurisdiction shop is much more mainstream than people think it is. It's not unpatriotic, it's not immoral, it's smart business. And it's no less reasonable when Apple does it than it is when Tiger Woods does it. Now, it's widely accepted that Apple's use of offshore structures is legal, according to the laws of the United States. And now, while I may be a proponent of the Cayman Islands, I'm not naive. I know that, of course, there may be times where some taxpayers, and certainly taxpayers in the United States, may make use of Cayman's services in order to violate the laws of the country that they live in. Now, they may open bank accounts in the Cayman Islands and fail or refuse to disclose them to the IRS. It reminds me of a very interesting time when I was a young boy in the 1970s living in Montreal, Canada, when my neighbor used to take my brother and I and ask us if we wanted to go for ice cream. Now, the only difference is that when he would ask us to go for ice cream, he'd like to go to a place that was 4 hours away in Plattsburgh, Vermont. Now, I never really understood what my neighbor was doing, but after he passed away some years later, I was speaking to his family, and I started piecing it together. See, my neighbor had some investments in the United States. He owned some property or something. And he collected all of his income into a bank account in Plattsburgh, Vermont. Now, I don't know for certain, but I'm quite sure that he never disclosed the existence of that offshore income or that bank account to the Canada Revenue Agency. Every time we would go to Plattsburgh, Vermont, in addition to buying us ice cream, he would stop at the local bank and he would take out some money, take out some cash, and he would take that cash back to Canada with him, and he would use that money to live on. Now, I'm not claiming that Plattsburgh, Vermont is a tax haven or that the bank in town was part of some big tax scam or something like that, keeping a secret. I think it's a reasonable explanation that the reasonable explanation in that case is that the bank manager probably informed my client that he had an obligation to disclose the existence of that account to the Canadian authorities. And then what ended up happening was that my neighbor just didn't. And that was that. It's no more reasonable to argue that Plattsburgh, Vermont, or this bank in town in Plattsburgh, Vermont, was laundering his money than it is to argue that a service provider in the Cayman Islands was doing the same. I think it's probably more likely that the bank manager was simply providing that person with a service that he lawfully provides to other people. Now, I spent a lot of time arguing what the Cayman Islands is not, that the Cayman Islands is not a tax haven, that the Cayman Islands is not keeping secrets, and that we do not turn a blind eye to illegal activity. I spent a lot of time explaining to you what Cayman does not do, so I'll just spend a couple of minutes telling you what Cayman does do, to explain why businesses choose to use the Cayman Islands. So it's been a lot of time, it's been a number of years since I was going to Vermont with my neighbor, and the tax situation in the United States and Canada have changed. This chart shows the after-tax income of a single professional living in the state of California, making $250,000 a year without any accounting for any specific deductions. Now, you'll see that this person living in the state of California brings home $149,452. Here's the similar person living in Manhattan, and after the application of federal, state, and city taxes, the person takes home approximately $147,625 a year. Now, here is another illustration of a similar person making the same money living in Canada, making the same $250,000. And in all but 3 of the 12 jurisdictions here in Canada, our person takes home more money by being a Canadian taxpayer than they would if they were a U.S. taxpayer. In fact, if they lived in Toronto, they would take home $155,000 a year. If they decided for some reason they wanted to live in Edmonton, Alberta, they would take home $166,000 a year. So my question is that when you look at the situation between Canada and the United States these days, when did Canada become a tax haven? Now, my point is that over the years, taxation in the United States has crept upwards, so much so that many Americans, and I'll bet that many people here in the room today, feel overtaxed. In many cases, wealthy Americans are taxed more than their Canadian counterparts. And there are many other examples of these types of problems. Sarbanes-Oxley has imposed significant regulatory restrictions and disclosure requirements on companies listed on U.S. exchanges. Now, Sarbanes-Oxley was a response to the large failures of Enron and WorldCom, but it's had a very negative effect as well. A decade ago, the New York Stock Exchange listed half of the world's IPOs, but by 2006, that changed to 1 in 12. And the exodus is happening all over the place. In 2008, 235 U.S. citizens renounced their U.S. citizenship. In some years prior to 2006, that number was as low as 15 people. Now, this is among an approximate population of 6 million Americans living outside of the United States. In 2010, that number went to 1,500, and in 2012, that number jumped to 4,650. Now, of course, these numbers are small in their absolute terms, but you cannot ignore the trend. The implementation of FATCA, for example, is causing a nightmare in the international business community. Now, at first blush, FATCA seems reasonable if they're trying to police their population in the United States, but the implementation costs of FATCA are going to be in the billions of dollars of direct costs to the U.S. government, and the tens of billions of dollars if you include private sector implementation costs. But FATCA is only expected to generate $800 million a year in new revenue to the U.S. government. That's only about $135 per U.S. citizen living outside of the United States. Overtaxation, overregulation, and the increased cost of litigation have all contributed to the flight of capital to markets like the Cayman Islands. And it's not just coming from the United States. The European Union has implemented significant regulatory restrictions, including the European Union Savings Directive, the AIFMD, they've set up the UCITS. And what this information shows us is that capital is fluid. Capital will always find a way to a place that treats it the best, to the place that puts the least amount of barriers up against it. And I'll say that again because it's one of the most important things that I'm going to say today. Capital will always find a way to a home that imposes the least amount of barriers against it and where it is treated the best. And I said it before, the Cayman Islands does not impose any personal income tax, no corporate income tax, no capital gains tax, no inheritance tax, and no property taxes. The Cayman Islands does not impose any significant regulatory restrictions or filing requirements on international businesses that use the Cayman Islands as a base from which to go out to the rest of the world and do their business. People and businesses around the world have always shopped for a better, more friendly business home. And despite what you might read in a John Grisham novel or see in a Hollywood movie or hear from a politician trying to push their own agenda, Cayman is actually at the forefront of preventing money laundering. Cayman does not sell secrecy. Cayman sells neutrality. Cayman is not trying to be a tax haven. Cayman is trying to be a facilitator of international business. Frankly, when you're looking at the business climate in the United States and Europe these days, and when you're considering the flight of capital from the US, I would argue that the Cayman Islands is not the problem. The Cayman Islands is a safe harbor in the storm that is going on in the onshore market. The Cayman Islands is the answer to a question, and it's the same question today as it has been forever. Where is the best place for me to open up my business? Location, location, location. And I want to add only one more point. If some of the biggest, most successful, most profitable companies in the world, advised by some of the best lawyers, accountants, and financial advisors that money can buy, if Mitt Romney and Jack Lew are all using the Cayman Islands, then maybe you should too. Thank you.